The Federal Reserve just sent you a warning.
This is the warning Wall Street is pretending not to hear. It's a signal that has only flashed a handful of times since 1957, and every single time, it was followed by a pretty big market downturn. And look, with 2026 just around the corner, this isn't some far-off theoretical problem. This is happening right now.
Okay, so let's get right into it. That number, 39.4, that's the S&P 500's current CAPE ratio. Think of it as a long-term price tag for the stock market. And this reading, it's the second highest it has ever been. The only time it was higher was right before the dot-com crash wiped out half the market.
Yeah? So what does this actually mean for you? I mean, if you're a millennial, you've got a 401k, maybe an IRA, this stuff really, really matters. But listen, this is not about panicking. It's about being prepared. By the time we're done here, you're going to know exactly what the Fed sees coming, what history says happens next, and the 3 most important things you can do right now to protect yourself. All right, let's start at the source, the warning itself. Fed Chair Jerome Powell. He said something recently that kind of flew under the radar for most people. He said that by many measures, stocks are fairly highly valued. Now, you have to understand, in the super careful language of central bankers, that's basically a giant flashing red light. And the key metric they're looking at is that CAPE ratio we mentioned. It was created by a Nobel Prize winner, Robert Shiller, so it's legit. It's one of the best tools we have for telling if the market is, cheap or expensive over the long haul. It kind of smooths out all the short-term noise to give you a much clearer picture. And this right here, this shows you just how wild things have gotten. The long-term average for this ratio is about 17. We are at 39.4. That's more than double the normal level. And see that top number, 44.2? That was the absolute peak of the dot-com insanity back in '99. We are uncomfortably close to that same territory. So the big takeaway here is that this is incredibly rare, which leads to the million-dollar question, right? What does history tell us happens next? Well, the answer is not great. Looking back at every single time the CAPE ratio got this high, the average return over the next year was -4%. But wait, it gets worse. Over the next 2 years, the average return was a staggering -20%. And this isn't me predicting anything. This is the historical average from almost 70 years of data.
Now, look, averages don't tell the whole story, right? The best one-year return in these situations was actually a pretty decent +16%. But the worst? A devastating -28%. So the main point is, while a good year isn't totally impossible, the historical odds are just heavily, heavily stacked against you.
Okay, so that historical data is worrying enough on its own. But there's another huge factor that makes this time different, potentially more dangerous, something that wasn't as big a deal in past bubbles. And that is the massive mountain of government debt.
$38 trillion. That's the current U.S. national debt. It's a number that's almost impossible to wrap your head around. But honestly, what's even more concerning is who owns all that debt.
See, what you've got to understand is that who holds the debt has been changing. It used to be mainly foreign governments. Think of them as stable, long-term investors. But their piece of the pie is shrinking. And who's filling that gap? Hedge funds. These guys are all about profit, and they are way more likely to dump everything at the first sign of trouble, which could make any crash happen that much faster.
A former Treasury official put it really bluntly. He called this the end of easy times. What he's saying is that the old safety net, that reliable, steady demand for U.S. debt that kind of propped everything up, it's starting to fall apart. The whole system is just more fragile.
Okay, now here's where things get really interesting. Because you're probably seeing all this and thinking, wait a minute. Every analyst on TV is super bullish. They all say the market is going up. And you know what? You're right. So let's talk about that massive disconnect.
So on one side, you've got Wall Street analysts with their target for the S&P 500 predicting a gain of over 15%. And on the other side, you've got 68 years of cold, hard data saying that at these levels, the market loses an average of 20% over 2 years. So, who's right?
Well, let's be honest. Wall Street's job is to sell you stuff, to be optimistic. But what about the Fed, the people who literally control the money? They're the ones sounding the alarm. Multiple Fed governors have been openly warning about stretched valuations and the risk of, and this is their quote, outsized asset price declines. Look, when the referee of the game tells you it's getting dangerous, you should probably pay attention.
And if all that wasn't enough, there's one more massive warning sign I haven't even brought up yet. And this one comes from, well, arguably the greatest investor of all time, Warren Buffett.
Buffett has a favorite way of checking the market's temperature. He just compares the total value of the stock market to the country's economy, its GDP. Around 100% is considered normal. Anything over 115%, he says, is overvalued. And right now, we're at 220%. We are way, way into the territory he considers extremely dangerous.
And that's not me putting words in his mouth. He has said explicitly that buying into the market when this indicator is over 200% is playing with fire. It doesn't get much clearer than that. It's a direct warning from the most successful investor on the planet.
Okay, so we've looked at the warnings from the Fed, the data from history, and the fire alarm from Warren Buffett. It's a lot, I know. It's a sobering picture. So that brings us to the most important question of all. What do you actually do about it? Let's get practical.
First things first, and this is the most important, do not panic sell. Trying to time the market is a fool's game, seriously. Instead, here are 3 smart, measured things to do. Number 1, audit your real risk. Just ask yourself a simple question. If the market dropped 30% tomorrow, would I be okay? If the answer is no, you're probably taking on too much risk. Number 2, think about rebalancing. This could just mean shifting a bit of money from those high-flying tech stocks over to some more stable, boring companies, or maybe just building up your cash. And number 3, if you're in this for the long haul, just keep doing what you're doing. Keep dollar cost averaging. That's just investing the same amount of money on a regular schedule no matter what.
And honestly, this is the key mindset shift. If you're in your 20s, 30s, or 40s, a market crash isn't just a scary risk, it's a massive opportunity. It's a sale. It's your chance to buy into fantastic companies at a huge discount. That is how real long-term wealth is actually built.
So look, none of this means a crash is guaranteed to happen tomorrow, but the warnings are definitely there. The historical data is pretty convincing, and the risks are clearly higher than normal. The goal here isn't to make you scared, it's to make you prepared. Which really just leaves one final crucial question you need to ask yourself. Is your portfolio really ready for what history tells us could be coming in 2026?